Okay, guys, this is the moment that I've personally been waiting for a good hot minute when it comes to the housing market. The last 5 or 10 years, I've been loading up on single family homes as an investor, using them as rental properties, just holding those properties. And the question is, will we see another housing crash like we saw back in the Great Recession? All right, let's tune in here to what Michael Zuber had to say recently on the Iced Coffee Hour. This is titled, "It's 2006 Again. The Real Estate Crash No One Sees Coming."
What do you think about the difference between like a big apartment complex versus just single family homes, residential?
I'm so glad we got here. And let me take you guys back to '06. Let's talk '06 residential. So '06, if you don't know, that was pre-crash because most people talk about '08. So this is what happened in 2006. 51% of loans originated were ARMs, adjustable rate mortgages, 51%. I believe 17, it might have been 19% of those were what's called pick a payment. Do you guys remember pick a payment? Pick a payment was essentially negative amortization. You had 4 payments. You could pay the 30-year full PITI, 15-year PITI, interest only, or negative AM, which meant $500 below the payment. We'll add it to the back of the debt. Pick a payment.
Wow.
Guess which much people picked? Pick a payment, right? It's the lowest payment by far because you're just adding the debt.
Yeah.
Those are now illegal, but they were very common.
Yeah, I can see why they're illegal. Now, I was back then buying and flipping houses, and I don't remember the pick a payment option. I don't remember that. That's a new one. I hadn't heard that yet, but I definitely bought and flipped a lot of homes back then. It's literally why I lost everything, because like I was a real estate agent. I got in real estate in 2002 as a real estate agent, but the as I was flipping homes on interest only money that I literally did not have to document my income to get, loans that I should never have even gotten. There was literally no vetting process. The only vetting process was is the banker called his buddy appraiser, which, by the way, that's why the regulations came in that bankers and lenders have to have a third party to contact the appraiser. And so like the banker would call the appraiser and literally just tell him what he needed the property to appraise for to get this loan through. Wild times
in '06. So in '06, we had a lot of speculation. Everybody thought residential would go to the moon. People were saying residential never crashes. We had adjustable rate mortgages on steroids, and we know how that ended in residential. It blew up. I want you to now go to 2023, multifamily. Grant Cardone, all these syndicators are going out doing value add apartment buildings. We saw more transactions in 2023 in multifamily than we'd seen in decades. We saw assets trade 2 and 3 times in 18-month periods because people were just speculating, and the cap rates kept going lower and lower, and people were financing this with shorter and shorter bridge debt, having bad assumptions about rent growth and expenses, and all of that is blowing up right now. So my prediction for multifamily is there's going to be a lot of losses and opportunities in 2025. I believe the greatest opportunity for wealth building is going to be in commercial properties. I think residential has already seen the appreciation, unfortunately. I don't see a lot of pain building there. So again, prices don't go up or down very much, but I personally am excited about, once again, 1031ing a house like I did Norris Drive into more multifamily buildings. So there's a chance Olivia and I double or triple our portfolio because we sell houses and buy multifamily in 25 and 26.
See, this is it right here. This is the moment that I've been waiting on for a while because I knew this was coming. I mean, we've been talking about this for years and years, that all the commercial properties, the multifamilies, even like strip centers, etc., bought all these these investors that were literally not experienced because, like he said, Grant Cardone's and the other syndicators, really talking about this on social media, really had this uprising of syndication and really just inexperienced investors getting out there and using the moment of really low interest rates, locking into these ARMs, because most commercial loans are ARMs or adjustable rate mortgages on like 5-year ARMs, etc. And that debt is coming due at a 3 times the size interest rate, which will literally double, triple the note overnight, right? And you can't get any investors to come in and bail you out because the amount that you owe is way higher than the amount that it's worth in today's market. Because here's how commercial properties work. When the interest rate is lower, it makes the payment lower, and you can afford to pay more for the property. So prices go up when interest rates go down. This is not like homes. Homes are somewhat tied to mortgage rates, but not like commercial, because commercial is strictly numbers. They look at the income coming in and they dictate the price based on the income coming in by the payment that they have to pay. And so investors are always going to want cash on cash return. They're going to want, what their rate of return is going to be, their internal rate of return, across everything. Once the property appreciates, they want to see the path of appreciation based on how much they can increase the rent. And like right now, you've got the worst of all worlds when it comes to this. You have interest rates that literally tripled overnight, right? In the whole scheme of things, it was overnight. You got rates, you got a lot of loans that are adjustable rate mortgages. We're talking about trillions of dollars in commercial loans right now that are out there that are coming due. And like he said, 2023, there's a lot of these that are on 5-year arms. I mean, that's going to be 2028. Like you literally have from right now, people that bought in 2020. Okay, I think this year is just going to kind of be like the little trickle. I think next year we're going to see a nice little surge. But I think we've got 2 or 3 or 4 years worth of this. Now, he talks about in the end how the government could come and bail these banks out of all of this because it's literally trillions of dollars worth of commercial debt. So there's a chance that there's some protection here that happens to try to prevent this massive wave of commercial foreclosures. However, I still believe even in that instance, there's going to be this wave of incredible opportunities. And that's what I'm here for. And like I said, I have stacked up single family homes, and I am more than excited to own those single family homes and have the opportunity to 1031 those into commercial properties. Because my residential rental properties are the biggest pain point for me. Okay, in terms of renters and turnover and people being late and evictions and stuff like that. I've got 3 commercial doors. No, I've got 4 commercial doors, and they are the easiest properties to manage. I never hear from the tenants. They pay me like clockwork. There's never anything going on. If something happens to the building, they fix it. I ain't got to worry about nothing. And I'm excited to transition a lot of my residential portfolio into commercial properties over the next 2, 3, 4 years. I'm strategically, methodically going to take my time and time it out where I 1031 these properties right into some commercial properties. I feel like, as Michael said, this is going to be a big play over the next 3 to 5 years.
What areas do you think are going to be going down the most?
I think it's going to be the ones with the most new development coming. So again, looking at the map, it's the Sun Belt, which we're already seeing. I do think there are some markets that have the combination of tax hits and insurance hits that make it doubly expensive, like Austin resets every year. We have a lot of the Southeast and Florida and the Gulf Coast, Louisiana in trouble because of insurance. So I think there's a lot of, you can just look at the map and see the pain in that kind of where the Gulf comes into the to the US. I think that's where a lot of the pain is. But again,
which is exactly where I am. I'm right here in Gulf Shores, Alabama, right on the beach, right there in the Gulf, right where he's talking about. Baldwin County, that's where I'm at. And like right this second, I'm in the middle of, I have 3 acres right down the road. And it's literally 5 minutes from the beach. They're building a new bridge. They're also building a $130 million high school like 3 miles away from this property. And I'm getting 46 unit apartment complex approved so that I can develop that property. I'm fixing to break ground by the end of this year on a 46 unit apartment complex to be finished sometime within the next year, 18 months from groundbreaking, which means I'm going to be the proud owner of a brand new 46 unit apartment complex 10 minutes away from the beach. You know what I'm talking about.
If you step back from today, how do you get wealthy? I believe getting wealthy is 3 steps. Step 1 is you have to create disposable or discretionary income, right? You have to have something left over at the end of the month that you can save. Then you have to become elite at something. I chose a very, very small footprint way back in the day to become a lead at better than anybody else. It could be classic cars, it could be stocks, it could be whatever it is. It could be fish tanks and coral, right? Whatever you choose to become a lead at. And then you have to, you have to do that for a decade, right? Wealth is created by ownership over decades. The other thing you should really be looking at is what is the net worth of renters versus owners? It's very clear if you own assets.
But now part of me would say that the difference between that is because people are forced to save, and the type of person to buy a house is probably the type of person to also be probably more prone to budget, have a higher income, make a little more money, just overall. And that forced savings.
Okay.
I don't know. Let's
Over
play with
30
that.
years,
Let's
yeah.
play with that a little bit.
Yeah.
So when at least when I step back and I read stats about the average American,
Yeah.
what is it, like 80% of us live paycheck to paycheck?
Something like that.
Something like that,
yeah.
right? And if we look at home ownership rates, it's like 67%, roughly 67, 68%. So I'm not sure I buy that. I'm not sure I buy the fact that homeowners have some natural ability to save more than renters. Just looking at the stats.
But I think also that home ownership rate includes inheritances.
Oh, I'm sure it does. Yeah,
So I'm sure a lot of people would just get a home,
Okay.
maybe move in or, have access to it.
Yeah. I guess where I will agree with this is it is a forced savings, right? Because one of the things, again, you read in Rich Dad, Poor Dad book is your home a liability, right? That's a whole thing people get wrapped around. I just step back and look at, the time is going to go by. I'm over 50. Both of you are certainly under 40, if not under 30. And when I step back and realize where was wealth created, it was in owning assets. I think about my mom who bought a home in 1977 in the Silicon Valley. The only reason she was able to have any semblance of retirement is she sold that house. We never moved, same house I grew up in. She sold in, I don't know what it was, 2015, 2016. So again, it's a forced savings account for a lot of folks. The other thing we need to realize, to your point of buying the 600K house, 2 point, whatever it is, your shelter's fixed, X insurance and taxes, tidbits. Renters can't say that, right? One of the things in this whole renters cheaper is zoom out. Look what's happening to rent over the next decade or so. You think rent's going to go down, right, in the next decade, especially with less development of homes? So it's absolutely cheaper today, but will it be forever? And the other thing I would ask you guys to look at is we've kind of seen this movie before. We've seen an environment where rates went up 500 basis points, 600 basis points. Think 1981, 1982, 1983. 1981 is still the least affordable housing ever, even worse than today. We still did 2 million transactions, a lot of cash purchases like today. It has been this bad before, but again, it's just transactions will go down. That's what's happening today.
So
Yeah, he makes a really good point right there that back in 81, the year I was born, that was actually the worst housing affordability time frame that we've ever seen. It's not right now. And right now it's real similar. It's real similar, but it's not like we haven't ever seen. It's never been this bad before. A lot of people are acting like this is the worst it's ever been. It's never going to get better. Yes, it is going to get better, right? It's going to take a little time, right? Wages have to go up. Prices are adjusting right now on homes. Prices are adjusting down in a lot of markets right now. On homes, and you also have interest rates are down as low as it's been in like 4 or 5 months right now. So the trend is down. That's liable to come back up a little bit, whatever the case may be. The mortgage rates are fluctuating, of course, but the good news is that over time, just like back in the 80s, we're going to get past this, extremely unaffordable place when it comes to housing, and we're going to get back to a normal market. It is going to happen, ladies and gentlemen.
How are you navigating today's market? Because I'm looking as well, and I check every single day in the Las Vegas market.
Yep.
I've yet to see any property that makes sense to buy that is either not a huge fixer, so you have to put a ton of money just to make it work, and time, or just you're going to lose money every month. And so from my perspective, I'm like, why would anyone buy for cash flow in Vegas? It just doesn't make a lot of sense.
I'm looking in Vegas. I actually just have a show called Buying Vegas. Olivia and I just moved here, so I'm trying to create a new buy box for Vegas. So it is tough. It's really hard to cash flow. I don't think, again, I'm still learning it, so I don't know it as well as you yet. I think I'm going to have to change what I do. So I've been a long-term, year lease, month-to-month guy for 25 years. I may have to go to finished midterm. I may have to buy a house that is non-HOA so I can add a casita or an ADU in the back to Goose. So I think you just have to get more creative and look for opportunities. I'm still very much early, but I will be buying a rental in probably Henderson.
I think the only thing that might make sense is building an apartment. Like that could be the only thing, but even then land is so expensive. Is that going to take you 3 years to build, 200 units or something like that? How much is that going to cost? What's the downtime worth? And then by the time you're finished with it, would you have been better off just buying a treasury?
Yeah. So I follow a lot of people in the commercial space because I think that's where the big opportunity is. If you have the capital, I think the commercial market, again, defined as 5 units and above, is where a lot of pain is coming in 2025. I think there's a lot of commercial banks who are extending and pretending on bridge debt. There's a lot of shadow banking going on with non-QM loans that they just have to clean up. And I think there's a lot of value add deals that aren't going to be added. So we're going to be able to pick up stuff 70, 60, 70 cents on the dollar. So I wouldn't be building right now. I think you can buy stuff at a discount shortly.
I guess what I worry about is in a lot of those cases, because I've also paid a really close attention to the commercial market. And you hear all these stories of, the debt's coming due pretty soon and they're locked in at, 3% and now it's going to adjust at 5 or 6% and they're going to be losing money on that. I'm afraid that all it takes to keep it going is the Fed coming in and saying, all right, well, we're going to backstop some of these banks and we're going to subsidize some of these rates so that the market doesn't crash. There's so many variables that they could throw in there to just keep it going.
No, there's no question. The bank could create a short-term bank funding program for commercial loans. It'd be fixed tomorrow.
Yeah,
they could. I don't know that the Fed really cares about the shadow banking system. I would argue that the Fed, specifically Powell, wants to see more regulation and wants to see pain there. Now, it's not going to happen to JP Morgan or Citi or any of the big banks. But the non-banks, the mutual funds, the Wall Street funds, the debt funds, it wouldn't shock me if Powell sort of smiles that those guys are having to take some losses.
So what's your prediction for the rental market? Just across the United States, just overall.
So I think there's two rental markets. I think there's multifamily and I think there's single family homes. I think multifamily apartment rentals are going to go negative. I think they're going to go down. I think we have supply coming online specifically in the Sun Belt. It would not shock me if it goes down 3-4%. Single family homes, flat to plus 1%. Again, I think a lot of what we've seen in the last 4 years was too much too fast. It's kind of to your points, right? We've had this big run up in rent, this big run up in prices. And the only way to fix affordability, there's 3 things you could do: lower prices, lower rates, increase income. As I sit here today, I think we need 5 years of wages going up. We finally have wages higher than inflation. I think that continues going forward. I think it's just
listen to what he's saying. 5 years of increases, right? 5 years of wage increases to kind of catch up with where the market is. You've got interest rates, mortgage rates, you got prices. Like, listen to what he's saying. 5 years of increased wages to kind of catch up with this affordability issue, right? This is something that's going to work itself out. This isn't anything that's the end of the world type thing.
Just going to be years for wages to come up. And to that end, transactions are going to stay way, way down, right? We did 6 million transactions. I think in 2023, we're going to be low 4s. We have a broken housing market. This is the first broken housing market since 1981. Yeah. The move-up buyer is not playing. They're staying in their homes longer. Turnover used to be 8 years. It's probably going to go to 12 years. It's just, the market's not, you're not going to sell your $600K house. It's now 700 because you got this low rate. I think a lot of people are making that choices. So we're going to need time for wages to catch up.
What's your solution to this? If you had a magic wand and can fix the housing market, how would you do it?
If I could wave a magic wand, I would encourage every public builder, small and mom builder, to build smaller homes. For too long, we've been building what was called McMansions. Yeah. We've seen the average square foot for the last 20 years increase by something like 30%.
A lot of builders are
If I had a magic wand, I would go back and build what they were doing in the 50s, the 997 square foot, 3 1.5. I would build some 2.2s. I would just build smaller homes. And I'm not talking condos with shared walls. I'm talking smaller homes, yes, on smaller lots, but I want single family homes. I think Lennar is the first public builder to try.
I don't know if you guys have seen builders actually doing this. There's a builder in my market. I think they're building like 600 square foot homes. And I'm talking about an entire massive hundreds and hundreds of these homes that are just like boop, 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 right next to each other, 500-600 square foot. Like it's crazy. I think there are a lot of builders that are going to this smaller footprint. Can you imagine? Like throw in the comments what your thoughts are on living in a home like that. You know, like they've been building these 2,000 square foot homes, 1,800 square foot homes, for decades now, right? Do you believe that builders should go to building a smaller home? Like, are people going to actually move into, like, are they going to move out of their 1,800 square foot home and move into, an 800 square foot home?
They built some 661 square feet in San Antonio. They got some sub 1,000 in Sacramento. But if I could do anything, I would encourage smaller. We need entry level homes. That's the big piece that's missing today is entry level.
So it's funny, that was actually in my video yesterday where I covered shrinkflation in the housing market.
Oh, nice.
So building has gone back to the same square footage that we were in 2010.
Correct.
And building since the 1980s has increased by double. So what used to be 1,400 square feet is now the average home for a new construction is like 2,800 square feet. Now it's down to like 26. More builders are building, instead of walk-in closets, they're building a smaller closet that's not walk-in in exchange for building another bedroom.
There you go.
So you're finding a lot more of those. I tend to think that for builders, it's more profitable to pack in the square footage. And if you're charging, 150 a square foot, or it's costing that much, then it makes sense to maximize it because you have the materials anyway. Like building a little more is not going to be that much more money, but you could charge way more for a bigger house. So I think that my suggestion a while ago is to be able to take the interest rate with you. That was the one thing I never understood.
Oh yeah, listen to this part. I thought this was really interesting.
Why the rate had to stay with the house, and if you leave your house, you can't take the interest rate to another house. Like you're already approved for the loan.
Yeah.
It's already back. As long as it appraises for more, you would think that would be a great thing. I understand why banks don't want to be holding on to these, 3% mortgages, and they factor in that the average one is going to, be charged off in 10 years. They get their money back. And it'll encourage people to keep that loan for 30 years. So it kind of screw them.
Right.
But it would open up the housing market to be.
I think you were the first person I heard bring that up. I think that is a very creative and genius. Because again, think about it. 600K house, you want to trade up, you take whatever that mortgage is, 500 grand. You have a second for the delta, which is maybe at a higher rate. I think that's a genius and pretty creative fix. I would hope somebody looks at that. But that could help. That would get transactions.
Oh, absolutely.
Because we're missing the entry level home, right? You got into your first home. You thought it was going to be your first home. You got a 2.9% mortgage. Now the price is up 100 grand. You probably can't even qualify for it at 2.9. Certainly not at 7. You're stuck. If you can move it, I think that's a genius move.
Yeah. The other thing was taking the property tax basis with you, at least on that
portion.
On that portion that you sell. If you double up, let's just say, then it's a prorated basis. So half the house could be the old property tax. I don't know how on earth.
That would get messy.
If you move to a different city or something like that. But there should be bounds where maybe if you're over the age of 65,
there you go.
Within a certain county, you're able to exchange one
there
house
are
for
some
another
of those
to open up.
There are some of those, at least trade down. I know they're in California. I don't know if they're in Nevada, but if you're 65 and older, there's some county tax assessment.
What do you guys think about that? If you could take your mortgage rate with you, say you're in a 3.5% interest rate, you've got a 30-year loan, you maintain the years you have left on that loan into a new home, right? What's your thoughts there? Let's look at a few comments here and then we'll get out of here. In my opinion, a housing market crash is imminent due to the high number of individuals who purchase homes above asking price despite the low interest rates. These buyers find themselves in precarious situations as housing prices decline, leaving them without any equity. If they become unable to afford their homes, foreclosures become a likely outcome. Even attempting to sell would not yield any profit. This scenario is expected to impact a significant number of people, particularly in light of the anticipated surge in layoffs and rapid increase in the cost of living. So the thing there is the people, like Michael said there in the video, most people are hanging on to their houses way longer. Like I think the average is around 12, 13, 14 years. And if you got these things at a low interest rate, like this person's saying, despite the low interest rates, I mean, you got the home to stay there for 5, 10, 15 years. You're not all of a sudden going to say, oh, I'm going to sell. That doesn't mean that there aren't going to be a number of foreclosures, but we're just getting back to normal right now. We're not even back to pre-pandemic levels of foreclosures right this second. Okay. So yes, you're right. Dorothy Joy, we're going to have some foreclosures out of that scenario, of people that don't have any equity because they bought at the peak and were a little bit lower than peak, depending on what market you're in. But we're not going to see this massive flow, because get this, the regulations on lending that came in after 2008 created the scenario where people who are getting mortgages are vetted, they're over vetted, like they're overqualified. You're right. You know, if we see a bunch of layoffs and all this stuff, like there's some things that could happen that are unforeseen. But for the most part, these people are incredibly, it's not like back in 2008 where you literally got a loan that you could not afford. You had no business getting that loan whatsoever. It's not like that today. You've got a FICO score, like average FICO scores are incredible for people that have mortgages. 50% of the homes in America are paid off. A third of those owe 50% or less on the equity. And then the other third, you know, like most of those, when you really boil it down, are under 5% mortgage rates. Like, we're not in this massive bubble. Okay. There's, you know, as far as a housing crash is imminent. Now we're going to see a little bit of softening of prices, which we're already seeing, but it's not going to be anything like 2008, just due to the fact that they just brought in these incredible regulations, which were kind of a pain at the time, but now we're super glad because it cushioned the market where we won't see another massive wave of foreclosures like we saw. And plus, think about it. If we did get in that situation where a massive wave of foreclosures was going to happen, guess what? Government steps in and bails all the, you know, like they're going to do a moratorium like they did during the pandemic. Perfect example. Moratorium on foreclosures for like a year during the pandemic. If it wasn't for that, we would have seen a lot of foreclosures, but we didn't. Here's another one. Multifamily starting to feel like 2006 all over again. Everybody was chasing big gains, flipping deals fast, betting on rent hikes that never came. And now we're watching it unwind. Bridge loans are expiring, people overpaid, and suddenly it's not cash flowing. My worry is how many everyday investors got caught in this trying to build wealth. If commercial crashes harder in 2025, what's the play for people trying to protect what they've built? Sometimes you can't protect what you built when you get caught, man. My situation was a perfect example of that back in 2005-ish. That's when I basically lost everything, because that's when the market really started to come down, 2005. And like there was nothing I could do. Like if you put yourself in that position and you weren't thinking about the future, you're just trying to make a quick buck today, right? And you think that it's never going to end, you can find yourself in these situations. But I will say this, because of that moment, I learned how to invest correctly. I had to go through that moment to understand how to actually do this thing. And now, massive portfolio. I'm in great position no matter what the market does. Market goes up, I win. Market goes down, I win. So for the people you're talking about, the everyday investors that want to protect what they built, protect what you learned. And if you do lose through this cycle, like gear up, baby, because here comes another cycle. Let's see, one more. Every year a crash is predicted and nothing happens. Isn't that so true? Isn't that so true? So here's what I'll say to you guys looking to buy houses, you're renting, whatever the case may be. Just like Michael said, the net worth of renters versus owners of homes is dramatic. It's like 40 times. Like $10,000 is the net worth of a renter. Around $400,000 is the net worth of an owner, a home owner. And Graham was like, well, that's actually two different types of people. The owners are more people that are more, budget prone and, investment prone and saving prone. So it's really kind of like two different types of people. Okay. We'll buy that for a second, but like here's my suggestion to you: become an owner, like become that type of person so that you can build your net worth. And like as Michael said, homes aren't really going to go up or down too much from here on out. We've seen the massive increase in equity over the last 5 years of homes. If you own a single family home, whatever residential real estate over the past 5 years, congratulations. Right from here moving forward, we're not going to see any huge increases or decreases. Right now, we're kind of in a down market, so things are kind of softening. I say right now is, for the next 6, 8, I don't know how long it's going to last, is going to be the best time to become an owner. If you're a renter, you should be trying to figure out what you need to do to become an owner. And I'll say Generation Z, which is 13 to 26-year-olds, they're accounting for 1 out of every 4 first-time home buyer loans right now, which is a bigger ratio than the previous generations. So I want you to know, the American dream is still alive. People that are at the youngest demographic are buying more homes than their previous generations. Okay. And they're figuring it out. Right. And a lot of these Gen Z people, they're saving money. Like, they see what the situation is and they're saving money up to the point where they can make this happen, or they're doing 2 things. They're saving money and getting a gift from family. They're doing whatever they need to do to become an owner, because they understand that owning assets is the path to building your net worth. I'm going to link the entire interview with Michael and Graham and Jack. Shout out to Graham and Jack. I'll link the entire interview for you below so you can watch that. And I'll see you guys on the next video. Good talk.